Alright people, listen up. If you're an entrepreneur, a freelancer, a go-getter building your own dream, I applaud you. Did you know that many self-employed individuals can end up paying an effective tax rate significantly higher than their traditionally employed counterparts? Sometimes even reaching upwards of 40% or more when you factor in federal, state, local, and self-employment taxes? Yes, you heard me right, 40%. That's a huge chunk of your hard-earned money going to Uncle Sam. And it's a reality check that many new business owners face with a jolt. This isn't meant to scare you, it's meant to empower you. Because knowledge, especially when it comes to your money, is power. We are going to plug those leaks starting today, right now. Now that you understand the potential tax hit entrepreneurs can face, let's talk solutions. I'm not going to overwhelm you with 1,000 tiny tips right away. Instead, we're going to focus on 3 foundational pillars, 3 main strategies that, when implemented correctly, can make a world of difference to your bottom line. The first pillar, and perhaps the most crucial decision you'll make early on, is choosing the best legal status for your business. Are you a sole proprietor by default? Have you considered an LLC or perhaps an S corporation or even a C corporation? Each structure comes with its own set of tax implications, responsibilities, and benefits. The second pillar involves uncovering and maximizing little-known business deductions. So many entrepreneurs leave money on the table simply because they don't know what they can legitimately deduct. Finally, our third pillar is leveraging tax-reducing investments. This is where you make your money work for you in multiple ways, growing your wealth for the future while simultaneously lowering your current tax bill. Let's get down to brass tacks with our first pillar, your business's legal structure. The simplest and most common structure, especially when you're just starting out, is the sole proprietorship. If you're doing business as yourself, without forming a separate legal entity, you're likely a sole proprietor. The beauty here is its simplicity. There's minimal paperwork to get started, and you report your business income and expenses directly on your personal tax return using Schedule C of Form 1040. But hold on, because simplicity has its price. The major drawback of a sole proprietorship is that there's no legal distinction between you and your business. This means you are personally liable for all business debts and obligations. From a tax perspective, all your net business profit is subject not only to income tax but also to self-employment tax. This can add up very, very quickly. As your business grows and your income increases, the limitations of a sole proprietorship or general partnership often become more apparent, especially concerning liability and that pesky self-employment tax. These issues can become significant hurdles as your business scales. This is where considering a limited liability company, LLC, comes into play. An LLC can offer a more robust structure for your growing business. An LLC is a hybrid structure that combines the simplicity and pass-through taxation of a sole proprietorship or partnership with the limited liability protection of a corporation. This dual benefit makes it an attractive option for many entrepreneurs. This means, generally, your personal assets are protected from business debts and lawsuits. You can operate with peace of mind, knowing your home and personal savings are safer. From a tax perspective, the IRS doesn't have a separate tax classification for LLCs. This flexibility allows you to choose how you want to be taxed. By default, a single-member LLC is treated as a disregarded entity and taxed like a sole proprietorship, filing Schedule C. This can simplify your tax filing process. A multi-member LLC is typically taxed as a partnership. This means the business itself doesn't pay income tax. Instead, profits and losses are passed through to the members. This means you still get pass-through taxation, avoiding corporate income tax at the entity level. This can result in significant tax savings. However, the profits passed through are still generally subject to self-employment taxes for active members. This is an important consideration for your overall tax planning. So, while an LLC offers great liability protection, it doesn't inherently solve the self-employment tax issue on all profits by itself. Careful planning and possibly consulting with a tax professional can help you navigate these complexities. Section 5. The corporate route: understanding C corporations and making the right choice. Beyond LLCs and S Corp, there's another structure you might hear about, the C corporation, or C Corp. This is the standard corporate structure, and it's what most large, publicly traded companies are. A C Corp is legally separate from its owners, providing the strongest shield against personal liability. If the company incurs debt or is sued, the shareholders' personal assets are generally protected. This robust liability protection is a significant advantage, especially for businesses looking to raise substantial capital through selling stock, or those operating in high-risk industries where lawsuits are a more common concern. However, C Corp come with a significant tax consideration known as double taxation. Here's how it works. First, the corporation itself pays corporate income tax on its profits. Section 6. Unearthing hidden gold. The home office and everyday essentials deductions. Alright, let's move to our second pillar, business deductions. This is where you can actively reduce your taxable income by accounting for all legitimate business expenses. One of the most commonly misunderstood, and therefore underutilized deductions, is the home office deduction. If you use a portion of your home exclusively and regularly for your business, you may be able to deduct expenses associated with that space. This includes a portion of your rent or mortgage interest, property taxes, utilities, homeowners insurance, and even repairs. Now, the IRS has strict rules. Exclusively means that space is used only for your business. No dual-purpose guest room office if guests actually sleep there. Regularly means you use it consistently. There are two ways to calculate this deduction: the simplified method or the actual expense method. Section 7. Smart spending, big savings, education, travel, and tools of the trade as deductions. Continuing our exploration of often overlooked deductions, let's talk about investing in yourself and your business capabilities through education and professional development. This is an area where many entrepreneurs miss out on potential savings. Many entrepreneurs don't realize that costs associated with maintaining or improving skills required in their existing trade or business can be deductible. This means that the money you spend on enhancing your expertise can actually reduce your taxable income. This could include industry conferences, which are great for networking and learning the latest trends in your field. Online courses, workshops, and subscriptions to trade publications are also valuable resources that can be deducted. These tools not only keep you updated but also provide new insights and skills, or even coaching sessions that directly relate to your current business activities. Personalized coaching can offer tailored advice and strategies to help you grow. For example, if you're a graphic designer and you take an advanced course on a new design software, the cost of that course is likely deductible. This investment not only enhances your skill set but also makes you more competitive in the market. This is a win-win. You enhance your skills, making your business more valuable, and you get a tax break for it. However, there are nuances. It's important to understand the specific requirements to ensure your expenses qualify. The education must maintain or improve skills needed in your present work. This means the training should be directly related to your current job responsibilities. Expenses for education that qualifies you for a new trade or business are generally not deductible. This is a key distinction to keep in mind. So, if you're a consultant and you decide to go to law school to become a lawyer, those law school tuition fees probably aren't deductible as a business expense against your consulting income. Always consult with a tax professional to navigate these rules effectively. Section 8. Investing in your future, slashing taxes today. Retirement power plays for entrepreneurs. This section is all about leveraging your entrepreneurial spirit to secure a financially stable and tax-efficient retirement. Now we arrive at our third pillar, tax-reducing investments. And this is where things get really exciting because you're not just saving on taxes, you're building long-term wealth. Imagine the power of compounding interest working in your favor, growing your investments exponentially over time. For entrepreneurs, retirement accounts are an absolute powerhouse. They offer a unique blend of tax advantages and investment growth opportunities that can significantly enhance your financial future. Unlike traditional employees who might have a 401k offered by their employer, as a business owner, you get to set up your own, often with even better benefits and higher contribution limits. This flexibility allows you to tailor your retirement plan to fit your specific needs and goals. Contributions to these accounts are typically tax deductible, meaning they reduce your taxable income in the year you make them. This can result in substantial tax savings, freeing up more capital for your business or personal investments. That's an immediate tax saving right there. And who doesn't love saving money on taxes while simultaneously investing in their future? And then, The money in these accounts grows tax-deferred or, in some cases, tax-free. This means you won't pay taxes on the investment gains until you withdraw the money, allowing your investments to grow more rapidly. One popular option is the SEP IRA, Simplified Employee Pension Plan. It's a fantastic tool for self-employed individuals and small business owners looking to maximize their retirement savings. It's easy to set up and maintain, and it allows you to contribute a significant portion of your net self-employment income, up to 20% of your net adjusted self-employment income, or 25% of your compensation if you're incorporated, capped at $69,000 for 2024. This high contribution limit can make a big difference in your retirement savings. For example, if your net adjusted self-employment income is $100,000, you could potentially contribute $20,000 to your SEP IRA. This is a significant amount that can greatly enhance your retirement nest egg. That $20,000 contribution directly reduces your taxable income by $20,000. This dual benefit of tax savings and retirement growth is a powerful strategy for any entrepreneur looking to secure their financial future. Section 9. Health is Wealth and a Tax Break. HSAs and other investment gems. Beyond retirement accounts, there's another fantastic tax-reducing investment vehicle that every eligible entrepreneur should know about: the Health Savings Account, HSA. People, an HSA is a triple tax threat, and I mean that in the best possible way. First, contributions you make to an HSA are tax-deductible, or pre-tax if made through payroll, reducing your current taxable income. Second, the money in your HSA can be invested and grows tax-free. And third, withdrawals are tax-free when used for qualified medical expenses. That's a deduction going in, tax-free growth, and tax-free withdrawals for healthcare costs. Can you believe it? It's one of the best deals in the tax code. To be eligible for an HSA, you must be enrolled in a high-deductible health plan, HDHP. Many entrepreneurs opt for HDHPs to keep their monthly insurance premiums lower, so an HSA is a natural fit. Section 10. Real results, real savings, a case study, and your next steps to tax freedom. Let's bring all this home with a real-world example. Meet Sarah, a freelance marketing consultant. When she started, she operated as a sole proprietor. In her first successful year, she netted $90,000. After accounting for her personal exemption and standard deduction, her taxable income was still high, and on top of income tax, she paid the full 15.3% self-employment tax on that $90,000, which amounted to $13,770 in SE taxes alone, plus her income taxes. Her total tax bill felt crushing, and she knew she had to make a change. This was in early 2023. In mid-2023, Sarah consulted a tax advisor. First, she formed an LLC and elected S-Corp tax status. If you found this video useful, don't forget to like, subscribe, and share it with fellow entrepreneurs. See you in the next video, and until then, keep growing smart.